836 million reasons why wise guy Sean Williams is not touching Tesla stock with a 10-foot pole. And I'll give you an 837th million. It's because he can't afford a 10-foot pole. But we'll discuss it. I'm Brian. Welcome to my Tesla Weekend. So, Randy, I don't know. I know you saw this article, but I'm just going to run you through it paragraph by paragraph, because this Sean Williams is a, I don't like to say bad things, but this guy is a mental patient.
Well, first of all, he's with
The Fool.
The Motley Fool.
Yes.
Years ago, I had a lot of respect for the Motley Fool.
Yeah.
I haven't read an article that they put out recently that I thought, Anyway.
Motley Fool will have authors put up content telling you to do both things all the time. That way they can always say that, hey, in 2023, we told you this. Right. You told me the other thing too. Right. But you got to you got to decide for yourself. Right. Because if you could predict the market, you wouldn't be selling me articles. Is Tesla's profit built on an unsustainable house of cards? The past 30 years have featured no shortage of next big thing investment trends on Wall Street. Everything from the advent of the internet to the development of AI has captivated investors' attention. But over the coming years, it's the rise of EVs that could drive some of the highest and most consistent growth. Does that sound like keyword stuffing to you?
Well, yeah, to a certain extent.
It does. Although the EV space is highly competitive, now here's where the analysis kicks in. One company has become nothing short of a polarizing battleground. I'm talking about Tesla, the world's largest auto stock by market cap. While Tesla has ridden its first mover advantage, there are some very clear reasons to completely avoid investing in this high flyer. Now you notice he hasn't told us what the reasons are yet, but we're paragraphs in. Credit where credit's due. Before digging into Tesla's red flags, allow me to give them credit. It's the first automaker in well over half a century to successfully grow from the ground up to mass production. Is it?
In a century, actually.
Well, what about, that's only if you exclude all of China.
Oh, well, that's true. That's true.
It's true. So, right there.
Usually it's the American. Usually people say this.
He didn't.
It's so many people that are America-centric, and...
well, if that'd be great, but we're talking about the global automotive market.
Right.
We're talking about competition from BYD and Geely and Lee and all the...
SAIC.
And 100 other players. Great Wall Motors.
Yes.
Yeah, Wuling. Okay, more importantly, it's the only pure play EV maker that's generating a profit on a recurring basis. Well, how many are there?
Yeah. BEV is generating a profit, but they're not a pure play because they still make ICE cars, not many. I guess they're getting out of it pretty quickly.
And they're generating more profit than Rivian and Lucid and Fisker. So right there. Now we're talking about irrelevant stuff. Okay. Tesla has produced 3 consecutive years of profits based on GAAP principles and is 3/4 of the way through for hitting a 4th straight year. Great. Tesla's balance sheet's also something to marvel at within the auto space. Traditionally, legacy automakers have relied on debt to finance, and these guys haven't. Great. Meanwhile, Tesla closed out September with $26 billion in cash. Great. Additionally, Tesla's generating profit from other stuff. He mentions the energy, $500 million. Great. Yeah. So far, so good. Is Tesla's profit built on an unsustainable house of cards? So I know you know the answer to this. Give it to me in one word.
Yeah,
what?
Yes, absolutely.
Unsustainable house of cards, totally. I know what you're thinking. He's going to discuss the company's declining operating margin. While you're correct, I'm not ready to touch on that just yet. Oh, get to the point. The far bigger worry is how the company is generating its profits. Virtually every other major automaker on a combined basis, the expectation would be that Tesla's core operations, selling and leasing EVs, would drive the bulk of its profit growth. After all, the bull thesis for years has been that Tesla's first mover advantage and production efficiencies would allow it to produce EVs at a cheaper cost, which should lead to superior operating margin and a ramp up in production. Well, yes, right? I mean, they do have those things, don't they?
Yes, actually, I thought that was pretty well written.
I mean, right, but he's saying it like it should, but we're saying it does. It does. Right. Oh, let me read the next sentence. But this isn't the case, which is, by the way, a link to another article of his, which if we have time, we will cover.
All right.
The September ended quarter saw Tesla generate $2 billion, a whopping $500 million from automotive regulatory credits. Renewable energy credits are given by governments to Tesla for free, and the company is able to sell them at 100% profit to other automakers for carbon offsets. Is that sustainable or not?
Well, it is sustainable, but I would agree with him that I'm not particularly interested in that, other than the fact that it's wonderful for a stockholder as long as it lasts. And
right.
It'll probably last for many, many, many years. But
the competition's coming, Randy.
Yes, I know. But
all the other guys are slowing down,
right.
Which means they're going to need to buy more of them. They're going to have to buy more.
Yes.
And this money is available to everyone.
Everybody. Yeah.
Everybody. Stellantis, instead of Fiat Chrysler buying $100 million a month in these credits, they could have built their own factory.
Could have.
But they didn't.
Yeah. But yeah. I'm gonna just guess right now that he never balances that particular profit statistic with the fact that Tesla spent a lot more money in R&D, chargeable R&D in the quarter than usual, which kind of went the other way. So you see, you've got to balance these special costs out.
That's right. We're going to continue with him looking at one side of each number, but not the other. So another $282 million came from interest on the company's mountain of cash.
Good.
Don't get me wrong. I'm not in any way faulting Tesla for generating interest on capital that they have lying around. It's a smart move. So all told, of the $2 billion in profit, $836 million came from potentially unsustainable sources that have nothing to do with leasing or selling EVs. Does ZEV credits not have to do with producing EVs?
I think it has everything to do with them.
It is exactly. If you stop selling EVs, you can't sell the ZEV credits. It's part of it, guy. In other words, 41% of the company's income has a pretty big asterisk next to it. So here's the thing. He's saying if interest rates go down, those $200 million in interest go down perhaps to zero. What would happen to Tesla's sales if interest rates went back to where they were 2 years ago?
The other side of the coin.
The other side of the coin is that they would sell 3 times as many cars to the same people with the same monthly payment.
And when you have $26 billion to lend, your interest rate is never going to go to zero.
Yeah.
When you and I need to go down and get a CD, it could go to zero. But now when you've got $26 billion hanging around.
It's so crazy. It's so crazy. If interest rates went down, you're telling me Tesla would make less money. And you're telling me that the automaker, all the other guys are saying, we're going to miss our EV targets for 2023 and 2024, definitely, probably 2025, and then we'll see about the second half of the decade.
Yeah.
And you're telling me the ZEV credits they will go away at some point. In Europe, they'll be gone by 2035, completely gone. But through 2030, there could still be some. And in the US, they're going to be sticking around a good while. There's 3 other, but wait, there's more. In addition to the aforementioned, there are 3 even more prevalent reasons. The first, as noted, Tesla kicked off a price war with other EV makers and reduced the selling price across its 4 models on more than a half dozen occasions. Musk confirmed the company's pricing strategy is based on demand. These aggressive price cuts clearly signal that competition is picking up.
No.
No, it is not.
And if he's going to quote Elon on one thing, he should quote him on everything. So this has nothing to do with a lack of demand. It has to do with a lack of enough demand at a price point over and above the numbers that they were already selling. So we're talking about a dramatic increase in sales, not trying to equal a previous period's numbers, but rather going into huge amounts of new numbers where at some point the TAM, the dollar amount that the person can afford, goes down. This is what Elon has been preaching all year long. We have to be able to reach that customer that can't afford to pay that price. And that demand is true. It doesn't exist until you get to a guy that says, oh, $300 a month. Yeah, I can do that.
Right. And you've got the fact that this is a company that's still growing while their competitors, apart from the Chinese ones, are faltering. And Tesla's inventory levels are rising.
No, actually, quarter to quarter, they stay the same.
Well, it's in his previous article, and I think we will have time to get to it, because it's so dumb. It is breathtakingly stupid.
Do you want to talk about that later or now? Because
no, we'll get right into it.
Okay.
Yeah, we'll roll into it because we're almost done with this one.
All right.
That's not a good combination, and it perfectly explains why Tesla's operating margins have been more than halved over the past year.
Well, the operating margin was cut in half over the last year for a whole bunch of reasons, and one of the reasons that people don't fully, I don't think even the Tesla bulls don't fully get this yet. When you have a marketplace where there's demand outside of norm, and people just buying whatever car they can go get because there's no cars to buy, you can charge more and you're going to make more margin. I don't care what you're selling when you're in that kind of environment. And that environment never lasts forever, and it didn't last forever.
So
the margins are going to come down.
Which number do you think he's referring to?
He's talking about operating margin.
Yeah, he's talking about operating margin. Right. So why that? Why not look at gap margin? Why not look at EBITDA?
Gross margin.
Well, so what has the gap margin done over the same period? It went from 25 to 18.
Right.
That's
not half.
Yeah. That's not half.
Yeah.
The EBITDA went from 23 to 16. That's not half.
Right.
That's not even close to half. He picked the one number that looked the worst while ignoring what they've been spending money on.
Right.
The margins are still good. It's the it's just the one number that he doesn't like, which is he doesn't like them spending a tremendous amount more to build factories, put in machinery, and do R&D. Those would be things he doesn't want them to do anymore, I guess. Yeah. The second reason to avoid the stock is Elon. Yeah. He's drawn the ire of securities regulators on a handful of occasions and made countless promises with regard to innovations that haven't been kept. Can you name 2?
I can name dozens because I'm into it, right?
Right? Well, he says advances like full autonomous driving have been baked into Tesla's valuation. Have they?
No.
Yet the company remains no closer today to moving past level 2 than it has over the past 5 years. Holy.
Well, that was the most nonsensical statement, and provably nonsensical of the entire
5 years. 5. That's 2018, Randy. Holy.
Yeah. Yeah.
And the third reason is the valuation itself. If Tesla were a high-growth company, it is, with a superior operating margin to its peers.
It is.
That could be made, the case could be made that it deserves an otherworldly premium. But at 68 times Wall Street's forecast earnings this year, right, you're looking You're not.
You're looking at this year's earnings 2 months away from the end of the year. No, you should be looking at 2024's earnings now.
Yeah. A declining operating margin and more than 40% of its income deriving from unsustainable sources. Now they are, not could be, they are, that have nothing to do with the company's operating model. Horse patootie. The company's valuation can't be justified. Yeah. So his other article is almost the same article, but it didn't get the traction, so he wrote it again.
I see. There you go.
So that's why this one will go much quicker. While most investors are focused on... and again, if you're watching this, Sean, I don't know what to tell you, man. Do better. Do better. Do research. Do better, because this is bad. This is so painful. Yeah. Here's how rehashed it is. Few trends have been capturing the attention of investors since the decade began, quite like the rise of EVs. That's the same. You copied and pasted. Okay, so here's 3 under the radar data points that suggest Tesla's in trouble. It's been undeniably great for shareholders, but the company's latest reports paints a worrying picture. Are you getting paid by the word, Sean? If so, somebody needs a refund. Global vehicle inventory is soaring. Here we are. He explains how it's calculated. For the first quarter of 2022, Tesla had just 3 days of inventory, and now it's 16 days.
Let's see. What happened in the interim? Let's see. We went from a crazy over situation where nobody could get cars, and so everybody was completely sold out of cars, to a situation where it's more like normal. Let's see. Number 2, we unwound the special situation where you're shipping.
The expedite, the delivery wave.
Expedite, delivery, get everything done by the end of the quarter, so you can show people that you were doing well. And you've flattened that out, so you're obviously going to have more inventory. And, you're always going to have more inventory the bigger you get and the more countries you're serving, because now you're having to decide how to put that inventory out there. So that is obviously, anybody that's ever been in business and sold product and had a warehouse knows your inventory goes up as you get more and more stuff and as you serve more and more markets. So, and 16 days, nothing compared to the industry.
30 days is very normal, and 3 days is not sustainable, not healthy.
No.
It's not good. You don't want that. That's not the right number to have. And if you really wanted to give an honest comparison, you would look at days of inventory for EVs of other companies.
Right.
Forget the total mix. Ford has made something like 24,000 Lightnings or 16,000 Lightnings. 8,000 of them are still on dealer lots. You've got a year and a half of inventory. Not mentioned, of course. Oh, and he once again said, no other car company has grown from zero to mass production in 50 years. And that's just not true. So this guy is... And he brings up, again, the regulatory credits. Because, again, most people don't publish the first draft and then just make a second version with a different headline a week later. But
I want to, Brian. Sometimes when my videos don't do well, I want to just tell my editor, could you just rearrange, the video that we shot and put a new headline on it and put a new thumbnail and just call it new? I mean,
I wouldn't do that myself. I think I'd upset I would upset people who pay attention.
That's why I don't do it.
Right. And that's the thing is, I'm guessing that this gentleman does not have fans who would notice that he did a rerun, because it's shame. It's bad work. It's bad work, Sean.
Yeah, Brian, and it's not just this guy. Come on, I did a video over the weekend where I tore apart like 3 additional articles like that. All of the nonsense that was put out about the Hertz situation I couldn't believe how can people read the press release from Hertz and think that was bad news for Tesla. They talked about how great the customer service response has been to the issues. They talked about the fact that they were all solvable, and they talked about the fact they're still going to buy the 100,000 cars. Other than that, it was a horrible situation for Tesla.
It was so crazy. So I apparently people don't know this, but the way car rental companies typically work is they buy cars at a fleet price,
Yes.
where they go to the manufacturers and say, what are you getting rid of? What can you not sell? Aztec, got it. No one's buying it. Give us a rock bottom deal, because rental customers don't care. So they buy it at a price that's way below dealer cost. They get it for just take it. Just take it. They drive it for 15,000 miles, maybe 30,000 miles. And then with warranty still intact, they sell it at Blue Book, which means that Blue Book price a year later is still above what they paid for it. They got that car for free. Now, with all these EVs, they're facing massive depreciation, because the price a year ago was very high.
Yes.
And now they're trying to sell them. They're realizing that they held value well if you consider what the new car is. A used Tesla is barely cheaper than a new Tesla, which is why we bought a new one instead of a used one.
Right.
It just didn't make sense.
Right.
And the people we were looking at buying from were gutted, because we're looking at saying it's still too expensive. And they're like, but we're losing $15,000. Yeah, I can't help you there. You paid too much. I don't know. I mean, you had to buy a car. You bought a car. But these rental car companies aren't used to actually paying for cars.
Yeah.
They get them for they basically get the car for free, and all of the rental money is income. It's under warranty the entire time. The thing them saying, oh, the cost to repair and service is too high. What? You're not paying for service. You're not paying for anything that is a manufacturer defect. It's under warranty. And if somebody wrecked it, you're still not paying. Their insurance or your insurance are paying. No one's. What are you talking?
But I think they were concerned about the cost of the parts, which again last year were extremely high because of all of the problems in the supply chain. And I think that's what they're working out with Tesla. How can
what parts? What parts? They're not buying parts. If it's a manufacturer defect, it's under warranty, and if it's damage, the customer's the one paying for it.
Right, but what I'm saying is, in one way or the other, they'll end up paying though, because their insurance rates will go up or whatever. So I think this is what the one part of the article that I thought was so positive for Tesla. It was like, and they are working with us to solve these issues. Well, okay, that's part of your press release. It's part of your earnings call. You're saying that Tesla is working with us to resolve these, and they will be resolved. That was part of the press release.
Yeah. Oh, this well doesn't run dry, Randy.
I know it doesn't.
Feels like the flood waters are rising sometimes. So guys, in the comments, what did we miss? What did we misunderstand? You know what to do. You got to like, you got to subscribe, you got to tell me how incredibly disrespectful I am to Sean Williams. Poor Sean. Poor Sean. By the way, I went through the other articles that he had written, and they all seemed quite reasonable. Some of them I disagreed with, but not on a fundamental basis like this. I feel like he was just digging into just like trying to find something that looked good, and he just doesn't have the depth of knowledge necessary to cover a company like this. I think if he'd have dug deep into, NVIDIA, I know NVIDIA is one that he says sell because he doesn't think that it's going to have as strong of an AI future as some of the others. But the article that I read on that of his, I didn't see him making the depth of assessment. He was just saying that other players are coming along, and it may be that it popped too soon and that there may be a pullback. That's a reasonable take. But this, Sean, oh, do research, do better. Randy, thank you for your time.
It's been great, Brian, as always.
Yes, and as always, thanks for stopping by. What I was trying to steal your catchphrase, but
I don't remember what it is.
I guess you guys will just have to stay tuned and juicy and wait for the next one.